Edge designations, CAIA level 1, topic 8, additional portfolio strategies, reading 8.2, equity linked structured products. And again, just a little bit of comfort, I suppose, for those that have done CAIA level 1 in 2023 and perhaps were not successful. This particular reading 8.2, and you can see it in the word, equity linked structured products, it comes directly from what we saw previously in 2023. Remembering again, 2023 had in it a specific topic. Topic 6 used to be called structured products. If you look in the 2024 syllabus, it's not there at all. But all 4 readings that previously related to topic 6 in 2023 called structured products are still in the 2024 syllabus. Some of them have found their way into topic 2. Some of them have found their way into topic 5, which is called private debt. And the very last one has found itself into this new reading, new topic called topic 8 that also wasn't there in the previous years. It is there now, and that's called equity linked structured products. So we see we've got a brand new reading over here, which in and of itself finds its way now into reading 8.2. Okay, as per usual, we have got ourselves the learning objectives over here on the very front page for reading 8.2. There we go. Okay, and as you notice, it's all different types of structured products with an equity link attached to them. We'll talk about them, of course, as we go through. Page 1, page 2 continues onwards then with the learning objectives, and we start then on page number 3, reading 8.2, equity linked structured products. Okay, learning objective 8.21. Okay, demonstrate knowledge of structured products and types of wrappers. It sounds like a very fancy word, and we'll talk about what is a wrapper in a second. An equity linked structured product, okay, is, first of all, we can break it down. Remember, whenever we talk about structured products, it's many different securities that are what? Structured for the investor into a certain product to meet his specific requirements. Now we talk about an equity linked structured product. This can be broken down into 2 parts. The first part, okay, is collateralized by very low risk assets. Okay, and that's like almost the guarantee or the minimum level of return that is associated with those low levels of risk. So it comes with a certain level of minimum return. The second part adds the risky assets to the product, because remember, you also want a much higher return, but if you want to try and guarantee yourself a specific return, well, you need part 1 for that to use low risk assets. Okay, how would then this differ from what we saw in collateralized mortgage obligations, where we had a little bit of a low risk asset combined with a high risk asset? Okay, over here, the equity linked product is in fact collateralized with actual low risk assets, okay, which meet the investor's preferences for risk and return. Okay, they guarantees fees for the issuer of the structured product. Okay, we spoke initially a little bit about a wrapper. What is a wrapper? Okay, and a wrapper, and don't get overly confused or taken in about too much of it. It's a fairly simple concept. It's an equity linked product. Okay, it's just structured in a certain way. Okay, it's a legal contract between the investor and the issuer. Okay, and remember, it's not a one specific product called a wrapper. There are many different products that would go under this major heading. We will talk about 6 different types of wrappers as we go through. Okay, we've got over-the-counter contracts. Okay, we know what that is. Over-the-counter, just between 2 parties. Medium-term notes or securities. Okay, low-cost publicly traded instruments. We've got funds. Okay, and funds generally are a pooled investment. We've got life insurance policies, structured deposits issued by a bank, and number 6, Islamic wrappers as well. Okay, these are specific wrappers that provide investment products that comply with Islamic Sharia law. Of our page, top of page 4. Okay, let's have a look at 4 different tax structures that apply to wrap funds. Number 1 is a completely tax-free fund. Now, completely tax-free fund, we see over here, R to the star, okay, represents the after-tax return on my investment, is equal to the pre-tax return on the investment. In other words, there's no difference over here. Why? Because they are tax-free. The return on the investment is not taxed. As such, the pre-tax and the post-tax return are then exactly the same thing. Okay. It's also important to remember that yes, it might well be a tax-free wrapper, but the amount invested does not get a tax deduction. Okay, the gains therefore are made that are made on the investment are tax-free. Okay. We've also got number 2, fully taxed wrap fund. What's a fully taxed wrap fund? And you can see over here, these are taxed at the I suppose the highest marginal level. And then we're going to say the after-tax return is equal to the pre-tax return. Don't forget to adjust for the tax amount. Your net amount is obviously going to be the pre-tax return, and we adjust then for tax. Let us take a look here on page 5 at an example. An investor earns a pre-tax return of 15%, and he's got a marginal tax rate of 39.6. What is his post-tax return? Well, it's the 15% pre-tax times 1 less the tax rate at 9.06. And what do we notice over here? That essentially what is he getting out of the whole picture? He's getting out 1 less 39.6, okay, which is exactly then, okay, 0.60, almost 60%, okay. He gets out the balance, of course, then goes to the tax man. Ask ourselves a question, guys. What if there are 2 different tax rates, as there sometimes are in investments? Ordinary tax as well as capital gains tax. Look what we do over here, nothing too crazy. Okay, the after-tax return. And guys, you see this form and you think to yourself, the first question you say, do we have to learn that for the exam? Yes, you do. Second question is, please don't learn these off by heart. Just get an understanding of them. And they're fairly simple. As simple as that one that you saw over there. The only difference over here, okay, is we break it down into 2 components. Component number 1 says, what is my pre-tax return? What's my normal tax rate? 1 is the normal tax rate. And what's my weighting? Weighting 1. What percentage of my return is attributable to ordinary income tax? And then plus the weighting for capital gains. How much of it of my return goes to capital gains, is attributable to capital gains, times the capital gains rate. 1 less the capital gains percentage. Okay, nice and simple. And we take a look at an example over here. An investor earns a pre-tax return of 15%. He's got a marginal tax rate of 39.6, and as per usual, capital gains is at a lower rate. 60% of the return gets ordinary tax, and 40% gets capital gains. So straight away, all that you need to do over here, okay, is 60% over there, okay, apply that to the return. 40% over there, apply it to the return of 15%, and then just work with your tax rates. Ordinary tax, 1 less 39.6, capital gains tax, 1 less 15%. Run your numbers and you get to your after-tax return there of 10.54. But again, just very important, guys, when you see a formula like this, and there's more coming, by the way, good news and bad news. Good news is that they're quite easy to learn. Bad news is there are more of them. Okay, but just don't learn them off by heart. Just try and get as best as you can an understanding. Okay, we've got over here. Let's have a look at this one. And again, understanding it over here is key to make it a bit easier. Tax deferred. What does tax deferred mean? Tax deferred means that the tax is not payable now. It is deferred to a later point in time. Okay. And let's have a look over here. Okay. The tax deferred rep, okay, is where the accrued income is only taxed when you receive the actual income, which is at a lower point in time. Let's have a look. Fancy formula. Let's do this by way of example. Okay. And let's hopefully we can get an understanding of it. Look over here. An investor earns a pre-tax return of 15% from a tax-deferred account. What is a tax-deferred account? It's an account where the tax is deferred to a later point in time. and it's deferred for how long? 10 years, and he's got a tax rate of 39.6%. Okay, look what we do. Okay, first and foremost, okay, 1 plus 15%. In other words, he's getting a 15% return every year. Is everybody comfortable with that? I take that amount, okay, and we have this all in our brackets. I put it to the power of 10. Why to the power of 10? Because this investment at 15% is going to grow for how long? It's going to grow for 10 years. Okay, the 1 plus and the minus 1, those are all just the maths behind it. Okay, remember the first plus is when we add that on, that's the actual capital value of the investment. Okay, and if I just stop at this point in time, okay, if I just stop over there, we would say to ourselves, okay, wow, how much of a return have we made? Okay, everybody comfortable with that? That's the actual return. The problem is, well, that's the return I make for 10 years. As you can see, I put it to the power of 10. Okay, what do I do right at the end? What do I do right at the end, the next part? Okay, at the end, because it was deferred, but so I earn all the money, earn all the returns for a period of 10 years, and then what happens? Once it's all grown nicely, then what I do, and you can see, look at the growth, 3.04. That's great growth. Then step 2 is I tax it. How much of this 3.04, whatever it happens to be, how much of it do I get out at the end? I'm only going to get out how much? Okay, net of tax. Is everybody comfortable with that? Then what I do to get my actual return, okay, so this is step number 3, I put it to the power of 1 over 10. Why to the power now of 1 over 10? Because I want to get an annual return. Okay, so if you break this down step by step, and guys, I do strongly suggest that you do this calculation a few times and do it with the understanding of it. Step number 1, you're going to grow your return. Tax-free. For how long? 10 years at 15%. Then what do? Tax it. Then what do? Okay, put it to the power of 1 over 10 because you want an annual return, and putting it to the power of 1 over 10 will give you that exact thing. Don't forget to minus 1 on the back end. Just look at the maths of it, guys, the plus 1 and the minus 1, because that is where we're going to get. You just need to make sure you have accounted for all the maths concepts then correctly. Okay. Let us move on just a little bit over here. Over our page. So not yet, my apologies. Okay. Look at this one. We've got another interesting one. They're all interesting though, but this has another interesting one, which is then number 4. Okay, let us get going. Okay, tax deferred and deduction wrap funds. Okay, seems to have a little bit of everything in it over here. Okay, and this one we focus on, we get a tax deduction on the contribution to the fund, okay, as well as a deferral on the return. So you, in fact, you can see it's all in the words, isn't it? I get a deduction when I contribute towards whatever wrapper or whatever fund this happens to be, and my tax is also deferred until a later point, like it was over there in case number 3. Okay, so now I'm getting a little bit of what we call a double benefit. This is a fantastic one. Okay, so I get a little bit of a double benefit over here. Okay, and then based on that, my returns then are significantly increased because I'm getting two benefits. One, I get a deduction when I enter into the fund, and number 2 is my tax is then deferred. Okay, good. Let us have a look over here over the page, and this one looks even more mean, this particular formula. Wow. And let's have a look over here. Okay, we'll do this again by way of example and try to get an understanding more than anything then of the formula involved. An investor earns a pre-tax return of 15% from a tax deferred account. Okay, he's got a marginal tax rate of 39.6 at the time of contributing to the wrap fund. The rate at the time of distribution, so you can see what's happened over here, and just very important to note, and that's often why they do these types of structures, is that at a later point in time when the person then retires, perhaps 10 years later, so we defer the tax for 10 years, but what's managed to happen? Okay, his tax rate has gone down. In other words, the tax rate at the time of the contribution to the wrap fund was 39.6. Okay, however, when there was the distribution, okay, 10 years later, the rate had gone down, the marginal rate had gone down. So he gets another benefit there, doesn't he? Now, again, same story. Look what we're going to do. First and foremost, let's grow the investment. 1 plus R. Investment grows at 15% for how long? 10 years. Is everybody covered? That's the first part. We've seen that before. Okay. What I'm doing now, and a little bit of a slight adjustment over here to reflect the benefit that I'm getting, okay, is instead of just timesing by like what we did in the previous example, if you remember over there, we just times my return by 1 minus the tax rate. Look what I do here. I go 1 minus TN, okay, which is the tax rate at the time that I withdraw, over 1 minus the tax rate, what we call that's T0, and that's the tax rate at the time that I made the contribution. So I'm going to put that in a different color for you. I'm just making an adjustment over there to reflect the two different tax rates. Don't forget to put it to 1 over 10. Why 1 over 10, guys? Well, we put it to 1 over 10 just to make sure that we get an annual return. Don't forget to minus the 1. Run all your numbers and you get a return of 15.85%. You can clearly see we get the two benefits over there. Number one, the benefit of the deferral, that my tax is deferred until the end of the period, as well as the fact that I get a bit of a benefit as well based then upon my contribution, and that the rates were different when I contributed and when the amount was distributed to me. Okay. What we have here, this is what upsets people just a little bit. Nobody loves this section over here. They find it a little bit difficult, but let's take a look and just make sure we are familiar with it. Learning objective 823, structured products with exotic option features. And remember, because we are in structured products allows us to do all strange things. We can structure anything that we like in any different form that we like. So yes, we're going to have many different types of varieties of these. When you hear the word exotic normally contrasts to the word vanilla, which is plain and ordinary. Okay, and exotic options are more customized to the specific party's needs. And they're there to offer a bit of a tailor-made solution to the specific needs that are required. Okay, each exotic option, of course, will contain, and remember, when you think about exotic options, take the word exotic out for a second and just think about options. And again, options have all got the same stock standard options that are attached to them as any other normal option would. Okay, and just go back to your normal topic 2 intro to alternatives, and you've got everything there for you. Okay, we've got the cost of the option, the value of the option, payment dates of the option, payment amounts of the option, and cost of exiting the option. Okay, remember, of course, the payoff on an exotic option is non-linear, as it is for most options as well. Okay, you know, most options have some linearity. These are even less than that. We look over here, look at some of the features of structured products. We've got a PPP, which is called a principal protected product. And what does that do? And again, guys, when you see all these strange ones, try and work it out from the words. Principal protected. In other words, it protects the principal over here. So the amount that it guarantees a certain minimum return. Okay. And where does the guarantee from? How is a party, the structurer, how is he able to offer a guarantee? Okay. It comes from the FDIC, the Federal Deposit Insurance Corporation. Okay. For example, if the product used is a US Treasury, that inherently contains some form of protection. Okay, there we go. The participation rate is the rate that the product will increase. Okay, if the underlying increases. Or for example, if you've got, for example, a participation rate of 100%, every 1% that whatever you have invested in as an underlying asset goes up by 1, you'll get 1% as well. A 50% participation rate means every 1% that the underlying item goes up by, you will get an increased payment of half of that, or 50% of that, or 0.5%. Okay, in order to create a principal protected product, we can also make use of what we call a put-call parity relation. Okay, this we've seen before. What does it tell us? That the call option plus the present value of a bond is also equal to, that's what's called parity, is also equal to the put option plus the underlying asset. There we go. And remember, you can structure this in whatever you like. Okay, and look what we can do over here. A call option less a put option. How do you get call option less put? Remember, what did we do? Calls there, move the put option that side, it becomes a minus, is equal to stock stays where it is. Put the bond over that side, it becomes a minus. Okay. So we've got various strategies that we can use then to create what we call our principal protected product. Okay. Now, if we just have a brief look at what's contained over here. The right-hand side of my equation, in general, is called a protective put. Why is it called a protective put? Because remember, whenever you use a put, what's a put strategy? A put strategy will gain if you go along a put option. As prices fall, you gain on the put option because you're along the put. Put option is, remember guys, option to sell. So as prices fall, okay, in the market on the underlying, you gain on the put option. So it's a protected put. So you're protected against falls in the underlying. It's almost, as we say here, a little bit like an insurance policy. But the challenge is to go long any option. And here we are long a put. That costs money, which of course will reduce your potential gains. Okay. In the event that stock prices fall, okay, the put option will be worth more, and of course will be exercised. In the event, of course, being an option, if stock prices rise, well then the option is not worth very much, and the protective put will not be exercised. Looking at the other side of the put call parity, okay, I'm long a call option, I buy a call option, and I buy a risk-free bond. Okay, and what am I doing over here in this particular strategy, and why is it called a fiduciary call? Okay, fiduciary is generally a very good way and a responsible way, okay, to invest. Okay, and look what we do. When a European call option is purchased, okay, so first of all, I buy myself a European call option, and the present value of the strike price of that call option, I put it into an interest-bearing bond. That strategy there, number 2. When the investment matures, okay, then what? I've got enough money to cover the cost. Okay, if we're going to exercise the European call option at the end, well, how am I going to pay for it? Well, remember, I bought myself a risk-free bond, okay, that's got a face value, an end value equal to what? The exercise price and the option. So I have money to exercise if I wish. If I don't wish to exercise, and for example, this call option ends out of the money, it doesn't matter because I've still got the investment that I made in the risk-free bond. Hence, we call this a fiduciary call because it's a responsible way to invest, because whatever happens, I'll either have sufficient money to exercise the call option, make some nice money there. If it falls out of the money, well, it doesn't matter. At least I've got myself a risk-free bond return over there. Okay, good. We now look over here at exotic options. We've got Asian options. Okay, an Asian option, just to get a sense of what's in some of these guys. It works on the average price of the asset during the contract. It's not the price. We don't work on a price at any specific point in time. An average price call and put will have a payoff that's equal to the average price of the underlying asset less the strike price. And obviously, when working on averages, the reason we do that is it's just slightly less volatile. There's a lot of volatility when you work on one specific price at a specific point in time. If you work on an average, generally you get a little bit less volatility. We talk here about binary options. Binary options, it's just in or out. It'll pay a certain price. If the spot price is greater than the X, it doesn't matter how much greater. Either it is greater or it's not. And if it's not, it'll pay 0 if the spot price is less than the strike. There's only 2 options over here. Okay, and then just remember the word that you're looking for over here. You in or you out. We say binary options exhibit discontinuous payoffs. You're in or you're out. Okay, there we go. We've got what we call And yes, sometimes it says, oh, I'm going to be honest with you, okay, but it does take a long time to try and work it out, and if you find it is taking you too long, don't spend too much time then on it, please. Okay, a barrier option, okay, it's an option, okay, will depend on certain things. Let's look at the different kinds of barrier options. Okay, let's have a look over here. Okay, up and out call or an up and out put. Now let's have a look. It's got, and the key to remember when you're looking at barrier options, it's a two-stage process. Okay, up and out. Okay, what is up and out? Okay, if the option, okay, sorry, not the option, my apologies. If the underlying asset reaches the barrier level, in other words, it goes up. Okay, a certain point, up and out call. In other words, if the underlying asset reaches the level, because they're all barrier, reaches the barrier at a certain level, the barrier sets at about the current stock price. Okay, and that can be a call or a put. You could have it the other way in. Up, if the underlying asset reaches the barrier level, then we're in for a call and a put. Okay, and you can see, how do we contrast these two? Let's just use different colors. Okay, at the very first one, up and out. Forget about call and puts, because all of them can be calls and puts. So let's just try and make it as easy as we can. Any of these guys can be a call or a put. Okay, so let's put that's not what I'm focusing on over here. I'm focusing on more the direction that we are going. So let's have a look over here. The very first one over here is an up and out. In other words, if the underlying asset reaches a certain level, let's just give an example. I call it SO. SO is my underlying asset equal to 100. And let's call the level 110. The price level 110. Everyone count price level. Also, we're going to refer to that then as the barrier. So if my underlying asset over there reaches the barrier level, goes to 110, the option is dead, ceases to exist. Everyone comfortable? Because it's called an up and out. I don't even have an option anymore. That option then is completely gone. Does that make sense, guys? Okay, so we can see how that one works. Up and out. Okay, everybody comfortable? Next one is called up and in. In other words, if the option price, if the underlying asset reaches the barrier level, my 100 goes to the 110, my option comes into existence. Okay, and they're not so difficult. Okay, they're just a little bit challenging when we try and work out all the various categories over here. Okay, let's look on the other side then, guys. Okay, on the bottom level, let's say now my barrier is 90. Okay, let's go for the next one. The next one says, okay, down and out. Okay, if the underlying asset reaches the barrier level, in other words, goes from 100 down to 90, the option is dead. And the last one is down and in. If the stock price goes from 100 to 90, okay, it reaches the barrier, it comes into existence. Now, you ask yourself the question, are we playing games? Is this a bit crazy? But yes, what we look at over here, guys, is just the different levels before the option even comes into existence at all. Is everybody comfortable with that? So, yeah, it's a bit odd, but okay. But again, people look at these and say, oh my word, up and in, up and down, round and about, and everyone's getting a little bit confused. Read the words. Up. In other words, if the price goes up, up is talking about the underlying. If it goes up, then it's out. Up, if it goes up, then it's in. You just read the words, and it's actually fairly simple when you look at them. Okay, good. Barrier options, and why would you do these? Sounds a bit, just get yourself a normal option instead of making yourself so completely crazy. And the reason that we do these particular options is there's so much optionality attached to them, they're actually a little bit cheaper in buying a normal option. Okay, and another point is they often don't exhibit all the same characteristics as standard options as well. Okay, we talk about look back options. A look back options got payoffs that will depend on the maximum and minimum prices. Why do we call that look back? Okay, we look back and see what's happened over the term of the contract. Okay, floating look back call, okay, and I've got a floating look back put. Then you knew it was coming. Fixed look back call and a fixed look back put. What's the difference? Floating look back call, the payoff is the difference between the expiry price and the minimum price of the asset. Floating look back put, the difference in the expiry price and the maximum price of the asset. Because remember, again, we for calls we gain with low prices, puts we gain with high prices. Okay, and there's your floating. Look at and again, look back just means I'm going to look back over the period and find the highest and lowest prices over that period. Fixed look back, okay, the payoff, it's a European call option. The expiry price is not used. We rather use the highest price that the asset reached during the contract, okay, and the fixed look back put, we go for the lowest price during the contract. Okay, I hope that all makes sense. And again, guys, you're seeing, well, hold on a second, I'm going to come out of the section with about 20 different calls and puts in them. Yes, you will, but again, if you think about each one, they're not very difficult, and they are actually making quite a bit of sense as you read them. We've got a spread option. And a spread option, the payout is determined by the difference in two prices. In other words, the spread. We've got a quanta option. The payoff is in one currency and based on the underlying asset value on a different currency. Okay. Top of page 11. Demonstrate knowledge of popular structured products. We've got a principal protected absolute return barrier note. Wow. And again, guys, break it down. Principal protected, it protects the principal with what? An absolute return. Okay, it pays absolute returns to the investor if the underlying asset stays within the upper and lower barriers. That's why it's called a barrier note. If, on the other hand, the upper or the lower barrier is breached, the product will pay out the principal of the product. So you've always got your principal protected, but remember, okay, if you fall out of the barriers, you might end up with then you only get your fixed return. Okay, how would you replicate such a product should you choose? It's an at the money up and out call. When at the money, down and out put. And again, guys, don't be overly ordered. It's at the money up. In other words, if the price goes out, goes up to where? Up to whatever the barrier is. We saw this before. And out. It's gone. You no longer have an option. At the money down and out. In other words, we go down to the barrier. If it goes down to the barrier, out. You're out. You don't have an option anymore. What do you just get then? You just get your principal back. Okay. 825, demonstrate knowledge of the USIPA classification. Okay. And it stands for European Structured Investment Products Association. It's a non-profit that was set up to promote the interests of the structured retail investment products market. Okay. We have a look at three investment product subcategories. We've got capital protection structured products. And look at the words, guys. Capital protection. They offer long call option like payouts, but the downside is protected as well. So I get upside, but my downside's got a certain amount of protection as well. We get the following four products. Uncapped capital protection. It's got lovely downside protection, but less upside. Exchangeable certificates. Downside protection, a 100% participation rate in profits. Okay, but those profits won't kick in until a certain underlying value has been reached. Capped capital protection, you've got good downside protection, upside is capped. Capital protection with a knockout, you've got excellent downside protection, but your upside protection is knocked out at a certain point in time. And remember, always go back to our barriers. When you get a certain amount, well, you get knocked out at that particular point. Page 12, top of page 12, we've got another type of products. These are called yield enhancements. Okay, these offer short put option like payoffs. Short put is, remember, short means, remember, the minute you see the word short means you are selling. So if you sell an option, what do you get? Well, you get a certain return. What's that return called? It's called the option premium. Okay. You also get full downside exposure as well. What are two examples over here? Discount certificates. and barrier discount, where barrier means when you reach a certain level, they get kicked in or kicked out. Okay. Participation structured products, okay, that they offer exposure to an underlying index or an asset, okay. Profits are not capped at all. We've got two examples. They're called tracker certificates, and this particular certificate offers full exposure to the underlying asset. Twin win certificates, this seems to come up a lot wherever you see it. Everyone's asking about twin win certificates. Okay, they offer absolute return exposure over a limited range, okay, similar to a long position in an option straddle. Option straddle, what's a straddle, guys? A straddle is more of a volatility type trade, okay, and we've seen that going back. Of course, it's a bit of good revision, taking you back then to topic 2, intro to alternatives. Okay, we've got leveraged structured products. Okay, leverage, okay, doesn't fit into any of the other categories. That's why it's almost a bit of a new category in and of itself. We've got knockout warrants. Okay, it creates a limit on the amount of profit and losses, after which it gets knocked out. Double knockout warrants, okay, creates a limit on the amount of profit and losses over a wider range. And again, you can see, well, whoa, hold on a second, okay, you're just dealing with a whole batch over here of different categories. But again, just read the words carefully. Don't try and learn everything here off the heart, because as I said, it'll give you a little bit of a headache and difficult to learn everything off the heart. Just try and understand what you can see over there, and you'll see that it is relatively easy. Spread warrants offers bull and bear spread returns, and constant leverage certificate, they offer bull and bear spread returns and profits in excess of 100%. Over the page, top of page 13, we've got global structured product cases, things that are specific to the global market. Let's have a look over here. A US-based structured product with multiple kinks. Okay, let's have a look over here. And all I'm going to do is I'm going to have a look over here at the specific table. Okay, and look what it does. If the return is greater than 25%, what do you get as the investor? 25%. What if it sits between, let's change our color, if the actual return, the index itself, got between 0 and 25, well, you'll get what it was. So say, for example, the index returned, the actual index returned 15%, you'll get 15. If the index returned 50%, what do you get? 25. Am I comfortable with that? What if the return was between 0 and minus 10? Let's say the return generated minus 5%. What would you get? You can see there's a capital protector here, isn't there? Because you don't lose anything. Okay. What if the return, okay, was greater than less than 100%? You didn't lose the full 100%, but it was less than minus 10. What do you get? And look over here. You get your actual return, whatever it is, plus 10%. There's some kind of a protection for you there. Is everybody covered that? So I wouldn't learn this off by heart, guys, because I'm going to have to give you the details if they do. Okay, but you can see there's all different, there's caps and there's floors and there's protection. Okay, and all we know is that this particular strategy can be replicated by an underlying asset. You buy the stock, you buy the whatever it happens to be, plus a bear put spread, less than out of the call money. Wow. Just remember, guys, whenever you see the word plus, plus means you're going to go long, minus means that you go short. Everybody comfortable with it? Okay, we've got a German-based structured product with leverage. Okay, and this is a low-cost trading product and with improved liquidity. Okay, why improved liquidity? Because the issuer provides permanent bid-ask quotes. Such a price called a sprint. And what is your position equal to? A long asset position and a long call option on the asset and a short call option on the asset. What do we call that? There's your bull spread. So you buy the underlying asset if you want to replicate this particular strategy. And what does the strategy give you? You earn upside leverage when the price of the stock goes above the low strike price. The upside is capped because remember, you sold a call option in your bull spread, so there is a certain cap And remember, guys, please go back to topic 2, intro to alternatives, and look at these various option strategies. Top of page 14, Japan-based structured product with multi-currencies. Okay, and this particular product allows investors to invest based on foreign exchange rates and interest rates. Okay, such an example would be a power reverse dual currency note, which pays a fixed interest rate in one currency and receives a payment based on an interest rate in another currency. Okay, again, you can have caps and floors, that's why it's a bit of a structured product. Okay, learning outcome 827. Okay, structured products valuation. Okay, PDE. Okay, how do you price these particular instruments? A PDE is called a partial differential approach, and a partial differential approach, okay, assumes that we are able to determine price movements of the underlying asset, and then we can form what we call a riskless or a hedged portfolio based on the particular product. Assuming that the underlying asset is risk-free and interest rates are known and they are fixed, obviously there's some fairly heavy assumptions over here, then we do the following product. Number one, determine a formula that works out the change in value of the risk-free asset over time. Determine the value of the underlying asset using some type of boundary conditions, and work out the price of the structured product based then on the above variables. What if the products are not risk-free? Well, then we've got to work out the change in the value of the risky asset, okay, how that price will change relative to each other. The following steps are used in the procedure. Determine the relationship between the movement of the option and its underlying asset. Create a risk-free hedged portfolio consisting of, yes, the underlying asset as well then as the structured product. And then using the boundary condition, okay, set the return on the risk-free portfolio to a certain return and solve then for the value of the structured product. I wouldn't spend overly amount of time on this, guys. Remembering again, of course, are they going to ask you, please give full details then on the partial differential approach and how it is structured? No, because that would be a bit long. Just get an understanding of how it works. Remember, break it down between the two different kinds of products, risk-free products and products that are not risk-free. We've got two different methods when we use the partial differential approach. Okay, the analytical method, which uses Black-Scholes pricing model, okay, and the second method is a numerical based method, and when we use it when the structured product is just too complex for the analytical method. Remember, Black-Scholes model being a lovely model, but it has certain limitations attached to it. Okay, top of page 15, you've got simulation pricing. Okay, and simulation, when you see simulation, Monte Carlo simulation should come to mind. Okay, and that's when the PD approach can't be used. There's just too much complexity involved. Remember, simulation pricing, and specifically Monte Carlo, runs many, even thousands of different simulations to try and work out, as you can see, a large number of paths are created. They simulate the path that the underlying asset's value can take over time. We work out each value, we average them, we work out, and we come at an average price for the structured products. Fairly simple to use, of course, if you've got high computing power with you. You can't do this on a piece of paper, of course. We've got number 3, building block pricing. It breaks down the structured products, because remember, structured product is really just a breakdown of various underlying items. Each part or asset is valued, and we sum them together. Okay. When looking at each underlying asset, a static hedge is used to value that particular block, which does not adjust for changes in value over time, hence the term static. The more complex the product, the more difficult it is to match all products to assets that actually trade at efficient prices. Okay. The PDE approach does make use of dynamic hedges that change over time. Payoff diagrams. Okay. The payoff diagrams, we describe them in two manners. One in terms of the shape, okay, which shows the level of risk exposure of the structured products relative to the underlying asset. Okay, the level of the payoff tells us the amount of return we can expect on the structured product relative to its price. Just an important side note, obviously, investors must be very careful when investing in structured products. as we saw in the 2007 and 8 global financial crisis, when investors does not fully understand what they were actually investing in, okay, obviously that increases risk and potential losses as well. Structured products, the bias: investors may overestimate the returns or downplay the level of risk on structured product investments. They may be a little bit overconfidence. Okay, what is overconfidence bias? They are overconfident in terms of their own ability, judgment, or reasoning, and important, that overconfidence is not justified. Top of page 16, demonstrate knowledge and motivations of structured products. Why would investors want to get involved in structured products? Increased liquidity, increased returns, they get benefits resulting from diversification. Risk management benefits, regulatory advantages, they can use lower levels of capital because they are involved in different types of products. Better access to top managers, lower transaction tax costs, and lower taxes if they could structure it properly. Why would an issuer be motivated to enter into a structured product? They can earn fee revenue, excess profits, and reduced costs of financing. And here's a little typical exam question, okay, straight formula based, okay, asking you what is the pre-tax return given certain characteristics. Okay, and you can see over here, just by looking at the solution, I'm not going to spend any time on it, guys, but just by looking at the solution, you can see, okay, this is something that is a deferred amount, okay, because you can see the tax then is taxed there on the back end. Okay, so again, if you learn to understand the formulas and what's in them, the questions can be fairly gentle. Top page 17, there we've got your edge checker for you at the end of reading 8.2, on page 18 as well. 19 and 20 give you the edge checker solution. That then brings us, guys, to a conclusion then of topic 8, additional portfolio strategies. Reading 8.2, equity-linked structured products. Please do take a look at the learning objectives as we normally ask of you, just to make sure that you are able to understand them and know what's inside the particular learning objectives. If you are asked, you will be familiar then with those. As said, this brings us to a conclusion of 8.2, equity-linked structured products.